This is module number 4, a very important module where we talk about the income-driven repayment plans. Now, as you know from the previous module, an income-driven repayment plan is designed for someone who simply cannot afford repayment under a standard 10-year time-driven repayment plan. In other words, the gap is so big between their federal debt and their income, they just cannot afford a plan like the standard 10-year plan. And the bigger the gap, the more likely you're going to need an income plan. We mentioned earlier that pay and repay are the most popular plans for recent graduates, and a reminder that with income-driven repayment plans, the payments are based on income and family size, and they change annually. So let's do a little bit deeper dive on the income-driven repayment plans. So how are payments calculated with an income-driven repayment plan like pay or repay? The payments are based on income from the most recently filed tax return. The formula actually looks for adjusted gross income, AGI, and that can only come from a tax return. By the way, you may have heard of some borrowers getting a zero calculated payment the first 12 months after graduation when their loans come due. And that's the case, or is often the case, when they file a zero tax return for the prior year or had very minimal income. So once again, the calculation is based on income from the most recently filed tax return. It's looking in the past. Current income will be used, or should be used, if it is significantly less than last year, or the borrower did not file a return for, I believe it's the prior 2 years. By the way, look at bullet number 2. Current income used is significantly less than prior year. The COVID-19 pandemic is a perfect example of this. We're going to look at married borrowers in a moment, but suppose someone was married and their spouse made $50,000 last year, but he or she has lost their job or their hours have been cut back and they have significantly less income this year. The borrower can let the loan servicer know that last year's tax return is not indicative of what kind of income they have now. So remember, the calculation is based on last year unless the current income is significantly less than what is reflected on the prior year tax return. Look at that third bullet. Income increases are going to show when you renew or recertify the following year. So what about married borrowers? I would encourage you to keep this as simple as possible. Spousal income is going to be counted under all income plans when you are filing a joint tax return, because the AGI, the adjusted gross income number on the tax return, will include spousal income. But note that spousal federal student loan debt is also factored into the payment calculation. Now, folks, it's not a dollar for dollar wash. By that I mean, if your spouse made $50,000 last year and he or she has $50,000 in federal student loan debt, it's not as though they have no income at all. We just want you to know that if your spouse has federal student loan debt, that is factored into the payment calculation with pay and repay, and that can lower or help lower the monthly payment you'll be required to make under those plans. Now look at bullet number 2. There is only one way to exclude spousal income if spousal income is driving your payment up, and that is to file a separate tax return and use either pay or the much older income-based repayment plan known as IVR. Repay, the most recent repayment plan, the most recent income-driven repayment plan, always counts spousal income regardless of how you file your tax returns. Now, we would ask you, if you're married, don't assume you're going to need to file a separate tax return and use pay-as-you-earn. Use the loan simulator to estimate the payments filing jointly versus filing separately. Very easy to do at studentaid.gov/loan-simulator. So use the loan simulator to run those estimates, married filing jointly versus married filing separately. Now, there are certainly pros and cons to using income-driven repayment plans. The biggest advantage is clearly a more manageable monthly payment, because remember, The payment calculation with an income plan is not based on how much you borrowed. It's based on your income and to some extent your family size. Another advantage is that the use of an income-driven repayment plan can lead to forgiveness of your loan debt either through the Public Service Loan Forgiveness Program, and remember we have a separate module on that, or what we call term forgiveness, and we're about to discuss that on one of the upcoming slides. Perhaps the biggest disadvantage to the use of an income-driven repayment plan is that there are periods of time when the interest is going to be significantly higher than your monthly payment, and that's called negative amortization. You're making payments, but you're not covering the interest that you owe. And that's going to really be the case if the gap is really large between your debt and your income. So you're making payments, but your debt balance is actually going up, negative amortization. That's very typical of many medical residents and fellows. Now, this is not necessarily a disadvantage. It's just a characteristic of the plans. You have to renew these annually. You don't have to renew your plans if you're using a time-driven 10-year or 25-year plan. Those are once and done. The payments never change. An income plan you have to renew annually, and if you're late, the payments will increase dramatically and interest will capitalize. So be careful if you're using an income plan to renew on time. And lastly, the term forgiveness we're about to talk about. If you get to the end of the term with an income plan and you've not retired the debt, you have to pay taxes on the amount that is forgiven. That's not the case with the public service loan forgiveness, where the forgiveness amount is not subject to tax. So pros and cons to the use of income plans. Now, personal opinion, I think this is one of the most important slides you'll ever see on income-driven repayment plans and how they work. Once you're in an income-driven repayment plan, one of three things is going to happen. I'm going to use pay-as-you-earn as an example. Pay-as-you-earn has a 20-year term, Repay has a 25-year term. We have a separate module on how to choose between the two. I'm just using pay as an example. So if you use pay-as-you-earn, you've got 20 years to retire the debt, not a day longer. One of three things is going to happen. Either the debt will be forgiven after 10 years worth of payments through the Public Service Loan Forgiveness Program, and if that's the case, you'll never hit the 20-year term. But if you don't use public service loan forgiveness, maybe you thought you were and you ended up landing in the private sector, or you never intended to use PSLF in the first place, maybe you just used pay as you earn because it was the only plan you could afford, the second thing that could happen is you just retire the debt out of pocket before the 20 years is up. And that would be the case if there's not a big gap between what you owe and what your income is. Now, you could also not necessarily retire the debt, but at some point you could refinance it with a private lender. But look at the third thing. If you're using pay as you earn, you got 20 years to retire the debt. You don't do public service loan forgiveness. The gap was so big and your debt grew so fast in residency that it grew dramatically by the time you started your practice as an attending physician. Even if you're making all your payments on time, if you don't get the debt retired by the end of the term, the government will forgive it for you. That's called term forgiveness. But unlike the forgiveness amount with the public service loan forgiveness, term forgiveness is considered taxable income the year it is forgiven. So please pay special attention to this slide in terms of how the income-driven repayment plans work. Now, some quick takeaways as we wrap up this module on income-driven repayment plans. They do provide manageable payments because they're based on income and to some extent family size and not the amount that you borrowed. But remember, guys, the payments change every year and you do not want to be late renewing. Also, remember, there are many borrowers who use income plans who have no intention of trying to get their debt forgiven. They simply can't afford repayment under another plan like the standard 10-year plan. So just because you're using an income plan, it doesn't mean you're trying to qualify for forgiveness, including public service loan forgiveness. You apply online at studentaid.gov. We would encourage you to work closely with your loan servicer before you turn in your application, and do not let the loan servicer choose your plan. We'd encourage you to watch the module on pay versus repay. You choose the plan. Don't let your loan servicer choose the plan for you, and you can switch plans if needed. This is the end of module number 4.